Hey, what is up everybody? Sean here. And what I want to do in today's video is really give a very in-depth overview on the stock market. Because if you've been following this last year, if you've been looking in the news, different things, you're probably seeing a lot of people making a ton of money in stocks. And you're probably thinking like, man, like I really want to have some of my money work for me instead of me just working for my money. But yet you might be in a situation where you really don't know a lot about the stock market, how to go about it, and you just are very uncomfortable or unsure about how to do it. So what my goal is in this video is to give you a really solid in-depth overview of all the basics that you would need to know heading into the stock market so that you have a little more comfort, a little more confidence in your ability to actually begin investing. Now, keep in mind that in no way am I a financial advisor. I'm just a guy on YouTube, but I've been able to create a lot of success for myself in terms of real estate and stocks as well. And so this is just me kind of sharing my knowledge and my advice. But once again, I'm not a registered investment advisor or a financial advisor by any means. So this is just here to help the best as I can. So we're going to be talking about what is a stock, the difference between a stock and a fund. We're going to be talking about where you can actually go to buy some stocks. Also, how do you go about doing research to figure out what would be good companies to invest in. We're going to be talking about what kind of investor are you going to be, an active or a passive type of investor. How do you begin doing analysis on companies? What type of analysis should you be looking at? And then we'll talk about a few key metrics or ratios or different terms you'll need to start to become aware of. We won't be going into a lot of detail with that, but we'll be kind of diving into that some. And then towards the very end of this video, I'm going to talk about a few things such as, how much money should you be investing and what's the best way of doing that? And what are the different ways in which you can actually make money investing into stocks? So there's a lot of stuff that we're going to be covering here. So make sure that you have a pen and paper or you're taking notes because this is pretty in depth and you may have to watch this video multiple times in order to get a better grasp of it. But by the end of this video, you should have a pretty decent knowledge base on at least how to go about doing this. Now, of course, as always, I strongly advise that you do your own research, that you look into this more. Don't just take my word for it. You shouldn't just take anybody's word. You should do your own research, find multiple sources, and make sure that this information is pretty accurate. But let's go ahead and start with what is a stock. So basically, a stock is basically an ownership of a piece of company. What do I mean by that? Well, I like to think of it as like a piece of pie. Let's say you're wanting to invest in Apple. Well, every company has essentially so many slices of a pie, or what's known as shares of a company. So every company has a certain number of shares that they're able to sell in terms of ownership. And the more people that are wanting to buy those shares, the more the price will go up. So let me give you an example. Let's say I have a piece of pie and it has 8 slices, but let's say only one person wants to buy this pie or wants to buy a slice. Well, more than likely they're going to be able to get it for a very low amount, right? Because there's no competition. No one else wants it. So you can get it for a cheap amount. But let's say 1,000 people want to buy this pie or one of these 8 slices. What's going to happen? The price of that is going to drive up. So essentially, when you own a piece of stock, you actually own a very small portion of that company. It's going to be very small depending on how much money you put in, but you are a part owner in the actual company. And of course, the more in demand the shares are, the more people want those shares, the more the price will drive up. The less that people want, the more that people are selling or the less want that someone has of the shares, the more the price will go down. And that's going to be in according to how likely people think that the business is going to be profitable, what kind of future they think that the company has, different things like that. So there's a lot of reasons for why the price may go up and down, but that essentially is what a stock is. So let's talk about the difference between a stock and a fund, because this is something you're going to be hearing a lot of. There are stocks and there are funds. So what is the difference? Well, as I stated, a stock really is a single company, and you're buying a single share or multiple shares in one particular company. Now, the difference between a stock and a fund really is simply just a group of stocks. So instead of you putting, let's say, $100 into just Apple, for instance, if you put your $100 into a fund, essentially that fund is going to comprise of multiple companies. That fund may have Apple and Tesla and Google and Verizon. And so that $100 is going to be spread out amidst all the different companies in a certain percentage. So when you invest in a fund, you're essentially investing in multiple companies at once with that money, as opposed to investing in a single stock where it's only going to that particular company. Now, there's a lot of pros and cons to funds versus stocks, things like that. I'm not gonna go into a massive detail here because this video is gonna get insanely long if I do. But in essence, you just wanna know this, that when you invest in a fund, you're getting a lot of what's called diversification, meaning that your money is being spread out. Now, some of the advantages of being diversified into what's called a fund is that you hedge, that you mitigate a lot of risk. What do I mean by that? Well, if you put $100 spread out over, let's say, 10 different companies, well, if one of those companies tends to perform kind of poorly at one point, maybe they have a product launch that doesn't do well, maybe news gets out about the company or something and the stock market goes down, or that particular stock goes down, you have other stocks that maybe are doing well that kind of help wait it out so you don't lose all your money. Versus when you buy an individual stock, if that particular stock has a failed product launch or news gets out about the company about something negative and the stock goes down, well, all of your money goes down with it. So, investing in a fund can be a great way of diversifying, but of course, you have higher potentially of earning more money when you invest in individual stock, because once again, if that one stock does actually go up really high, well, because all your money is in that one stock, your money will go up as well. Now, I have some other videos, especially for funds. I have a video I'll put in the description box below on the difference between what's called ETFs, which are exchange traded funds. We also have mutual funds and we have index funds. So I do have a video, I'll put that in the link below. So make sure you check that out if you want to learn a little bit more about the different types of funds, which ones are the best, and some of the subtle differences between them. But for right now, just know that a stock is an individual company, a fund is comprised of multiple companies, and it could be anywhere from 10, 50 different companies to there are funds that have hundreds and even thousands of companies within that particular stock. So where do you actually go to buy stocks? That's the next question. Now that we kind of know what a stock is, we know the difference between a stock and a fund. If you're actually wanting to invest, where do you actually go? Now, there's a lot of different places you can go. There are some traditional institutional places, things like Charles Schwab, we have Fidelity, we have Vanguard, and these are, companies that have been around for a very long time. And you can go to their website, you can create an account, and then from there, you'd find the individual stock or the fund that you'd like to invest in, and you can make that investment. Now, what's been really trending a lot recently, especially the last few years, is a lot of trading stocks or trading apps on your phone that you can download, whether you have an iPhone or an Android. And these are going to be companies such as Robinhood, Webull, M1 Finance. In terms of which one is better, in my opinion, there's really not that much of a difference. Whether you want to go with a traditional institution or you want to do something from your phone, I would say the biggest thing you just want to look for is making sure that whatever one you use, there's not a lot of fees associated to investing with that particular company. And the reason being is that, the more fees that you pay, the less money that you're going to be able to profit, because some of that money is going to the actual firm or the brokerage as opposed to just sticking with you. Now, the next question, before you actually start to buy your stock, before you go on there and you invest, you want to start asking yourself, what kind of investor am I going to be? Now, what do I mean by that? Well, essentially, there are really two main types of investors when it comes to the stock market. We have active investors and we have passive investors. So let's start with the active investor, because this is typically the one that we usually think of when we think of the stock market. We think of all these crazy graphs and numbers and be like, okay, buy now and sell and let's hold, So an active investor is someone who typically buys and sells. Could be within just a few minutes, could be within a few hours, a day, a week, a month, or even a year. But active traders are people who basically actively buy and sell at a somewhat frequent rate. So, if you know of what's called option traders or swing traders, day traders, things like that, those are examples of active traders. They're people who are looking at the stock, they're trying to buy low and they're trying to sell high. And so this is active trading. So the other type of trading, which is known as passive investing or passive trading. And so when you are a passive investor, the whole purpose of this is you're really just looking at a very long term. Typically, people who are passive investors, when they invest in a company, they plan on keeping that company for many years and possibly even many decades. And usually what they're doing is they're just making small investments periodically over time. Could be over the course of every week, every month, every quarter, every year, but they're making an investment into that company pretty frequently over the course of the long term. Now, once again, there's a lot of pros and cons to active investing and passive investing, much more than I can go into in this particular video, but just know that, when it comes to active investing, some of the advantages are there is a higher potential of making a lot more money with active investing. However, statistically, most people actually do not, but there is that potential. With active investing, you do have a lot higher fees associated to it because you are going to be paying a lot more in taxes, also trading costs and stuff like that. But, there are some pros to it. And the fact that you really can start to make really, really good money. If there are people who actually make a full-time living simply day trading or swing trading or doing options trading, and they make a very, very great income doing so. But it does take a lot more work. And that is the other thing you need to consider. When you're trying to decide between should I be an active investor or a passive investor, how much time am I willing to put into this? You see, active investments, active traders are putting a lot of time into researching the financials of a company. They're looking at the trends or the emotional sentiments of the traders. They're looking at the things that are happening in the economy. So you have to spend a lot of time really understanding that particular company, understanding that particular industry or the market that you are investing in, and really getting a good understanding of the trends and the emotional swings of the people and the market itself. Now, a passive investor is someone who's like, hey, I don't have a lot of time. I work a full-time job. I don't really want to spend too much time doing this, but I do know I want to begin making money through investing. Then I would highly suggest start to look more into passive trading. These are people who, pick a few good companies or they pick certain funds and they simply hold on to it very, very long term. Now, I'm not going to go into crazy detail, but, a really interesting fact, if you invest in a fund, let's say like the S&P 500, which tracks the top 500 companies, traded on basically the Standard & Poor, a really cool fact is that no one has ever lost money who has invested in an S&P 500 and held for at least 20 years. So there really can be very little risk involved when you do long-term passive investing. Typically, the longer you hold on a long-term investment, the less risky it becomes. But of course, there is no such thing as a risk-free investment. But it's important to understand, are you going to be an active or a passive investor? Because that will help you decide if you should be, actively buying and selling, or if you're going to do a long-term approach. So this brings me to the next point, is the type of analysis that you need to do when it comes to these companies. So once you start to ask yourself, am I going to be more of an active investor? Am I going to be more of a passive investor? Well, this will help you also understand how you begin to analyze companies, because there will be a difference between how you analyze a company if you're an active trader or a passive investor. And so there's essentially three main types of analysis that happens when you are looking at investing in a stock or a particular fund. The very first one is a technical analysis. The next one is going to be fundamental analysis, and the third one is an emotional or sentiment analysis. So let's kind of talk about this a little bit. So the technical analysis, this is going to be the type of people, when you kind of envision those stock market people and you're envisioning all these different screens and graphs, and there's these green, candles, or these green little sticks and these red sticks and all this, crazy up and downs and these buy and sells. These are typically people who do technical analysis. Now, technical analysis requires a lot of in-depth knowledge and understanding of charts and graphs. And so you really will have to spend a lot of time understanding how those work and how to begin reading those things. But as a technical analysis person, you are really looking at a lot of the nitty-gritty numbers, and these are people who will probably be buying and selling within a few minutes or hours or even days or weeks or sometimes even months. But they're people who are looking at the very analytic graphs, and they're trying to determine where they believe the stock is going to go based on how the numbers are looking and how they're trending. Now, the next one is going to be fundamental analysis. And the main thing about fundamental analysis is that you're really looking at the overall just fundamentals of a company. So instead of looking at every small little granular detail of the numbers and the charts and the graphs, you're looking at a much bigger picture. And you're looking at, hey, is this a company that I think is going to be around for the next 5 years? Do I think that they are in a market or a niche that will continue to grow over time? What kind of leadership is going on within this company? Do they have good people managing this? Who's the head CEO? What's the main operations? Do they have good overall financials? Do they have a good, strong balance sheet? So you're looking at more of a bigger picture. You're not so worried about what's going to happen in the next maybe few hours or a few days. Typically, people who look at fundamental analysis, this is definitely going to be more on the passive investing side. It can be on the active investing side as well. But typically when you look at fundamental analysis, you are looking at more of a longer term approach. You're looking at how does this company look long term? How are they going to be in the next 5 years, 10 years, 15 years? Do I think they have a lot of growth? Now, the third one is emotional sentiment. This one's a little tricky, and you can use it either way between day trading or the active investing or the long-term investing. But even emotional trading is going to be more along the lines of the active trading. And this is, how do I feel that consumers and people are emotionally, so if there's a very hot trend that's happening right now, if you tend to invest on an emotional analysis or emotional sentiment, you may be more prone to investing and buying and selling things that are really hot at the moment because it's trending. So the next question becomes, where do you actually go to research these companies? Well, there's a lot of places that you can go. If you did invest in the institutional portion, so let's say you went with Charles Schwab or Vanguard or Fidelity, a lot of those companies will provide some basic overviews and breakdowns of particular funds or stocks, telling you about the history, what kind of risk is involved with this particular thing, like I said, the history of it. But if you're going on certain apps, whether it's M1 Finance, Webull, Robinhood, there are a lot of articles and things you can read about particular companies or particular sectors or industries. But one of the things I would highly recommend if you are investing in funds or in particular stocks is you want to start going to those individual companies' websites and starting to look at their annual reports. Every single publicly traded company usually has what's called annual reports. And essentially what it is, it's a really, really in-depth breakdown. This can be 30, 50, 100 plus pages of a financial overview of the particular company. They go over everything. They go over their revenue, they go over their potential growth, what's going well, some of the struggles, but they give a very in-depth breakdown of the financial statements. Now, there's a lot of things that you need to learn when it comes to breaking down financial statements, but just know that you want to start looking at what's called a 10K or an annual report. And you want to start to familiarize yourself. The more you read annual reports, the more you start looking at them, the more you'll start to get an understanding of, how is this company actually doing? What is the potential growth? What's the future like? I would highly recommend even checking out some books or going more in depth into what you need to be looking for in annual reports. Once again, this is not something I can go into massive detail with in one particular video. It would be insanely long if I did that. But you do want to start looking at annual reports of companies. Now, there's another thing called a 10Q, which is a quarterly report. So typically every company also every quarter has, calls, especially shareholder calls. So what's also interesting is that if you do invest in a particular company, a lot of times you'll be able to hop on what's called shareholder calls. So people who own shares of a particular company, companies do have these long phone calls where the head CEO or someone at the very high end of the company will begin disclosing the financial statements, begin disclosing how the company is doing, whether they hit their sales quota that they anticipated or not. And of course, based on those reports, a lot of times you'll start to see changes in the stock itself. So if you happen to notice, a lot of times when annual reports or quarterly reports are released, all of a sudden you'll start to see stock market swings. It may go up, especially if companies are doing better than anticipated. All of a sudden now the stock is going up some. But at the same time, if the company's not performing the way they wanted or the way they expected, sometimes you'll see the stock going down. So let's dive into the next component, which is the different key metrics and the different ratios that you should be looking at. Because as you start to pull up, you do these different charts, these different breakdowns, you're going to see a lot of different numbers and a lot of different terms that probably look like a different language. And so let's talk about a few of these things you should look out for. Now, in no way is this a super in-depth every single thing, but let's talk about a few key ones you want to start familiarizing yourself with. And I would definitely suggest going and researching more and getting more in-depth knowledge on these particular things. The very first thing you want to kind of look at is market capitalization. So let's say you're going on Yahoo Finance, you're looking at an annual report, or you're looking at a stock market thing and it's breaking down some key numbers there, and you see a thing that says market capitalization. Well, what that is a really, really fancy term for how valuable that company is at this particular moment. And the way they determine that is they add up the total number of shares, they take the total shares available to buy in that company, and then they multiply it by the actual price per share. So let's say that there's 100 shares in a company and every company is selling for, or every share is selling for $1. That means that company is worth $100. So essentially, if you see a market capitalization of a company worth, let's say $200 billion, it just means that based on the number of shares and the total price of the shares, that is the actual valuation at this point of the company. And of course, it's going to fluctuate based on how much people are willing to pay per share and how many shares are available. Now, the next thing you want to start looking at is what's called the price per earnings. And this is simply how much money are you paying per profit or earnings on this particular company. So this is also known as the PE ratio. So you'll see on the breakdowns a P/E. And this is a very, very important indicator because this is going to help you understand how much you're paying for particular earnings. And this is also a really great way of understanding, how this company compares to other companies in the industry. What do I mean by that? Well, now, granted, this is a gross generalization, but let's say you have two tech companies. They have the same types of products. Let's say you have Verizon and T-Mobile. And let's say that, Verizon has a PE ratio of 1. And let's say, T-Mobile happens to have a price ratio of 5. Well, and these are probably not the actual price ratios. I'm just throwing numbers out here. But, once again, if it's the same product, same competition, but one has a higher PE ratio, that means that that company is more expensive overall, that you're paying a higher amount for those particular earnings in that company. Now, that doesn't necessarily always mean that it's a worse investment. There are other things to that, but it does start to give you an example of and helping you start to realize, this could be a potential undervalued, because if every other company in that sector has got a 4 PE ratio, and this particular company that could have just as much growth, same products, and their PE ratio is a lot lower, well, that means that there could be a lot more potential room for the stock to go up, meaning that you could be buying at an undervalued rate. Not always the case, but once again, this is a decent indicator. Now, other ratios that you want to start to kind of familiarize yourself with, there's a beta ratio, and beta simply is a measurement of risk or volatility. So if you're wanting to find companies that are less risky or less volatile, when I say volatile, what I mean by that is how much ups and downs there's going to be. So a company that's very volatile doesn't necessarily mean it's a bad company. It just means that their stock valuation or their stock price is more prone to having a lot of ups and down swings. Versus a very, very large company with a low beta that's not volatile, it means that their price may stay a lot more consistent. So, the lower the beta, the less risky or the less volatile. The higher the beta, the more risky or the more volatile. Other things you want to keep in mind are the earnings per share or the return on equity, but essentially there are a lot of different terms and metrics. So what I would advise is get on something like Yahoo Finance or get a sort of a breakdown and start to see all the different terms. You want to research each one of these terms individually and see why this is so important. But these metrics are a very, very important indicator to helping you understand the finances of a particular company and whether or not this particular company is maybe undervalued, overvalued, how it compares to other companies in its sector or industry. Now, just as a side note really quick, two terms you're going to hear a lot of, especially with investors or terms out there, is bull versus bear markets. Basically, if someone is bullish on something, it means that they believe that that stock is going to go up. So bullish means that stock's going up. Bearish means that they believe the stock is going to go down. So bull markets simply just mean that you're in an environment or an upward trend in general. And then a bearish market means that it's a downward trend. Okay, so the last two things I want to talk about are the ways in which you can make money investing in stocks, and then also how much money you should invest. So when it comes to making money in stocks, you simply have two different ways. The very first way is the traditional way, which is that your stock valuation goes up. So what do I mean by that? So let's say that you invest in, let's say Apple, and let's say it's selling for $100 a share, which I wish it was, but it's not. But let's say it was $100 a share. And let's say you bought today, and let's say a month or two down the road, that stock is now worth $150 a share. Well, because the stock price went up, that means that your shares are more valuable. So what you own has more value. So if you were to sell it at that point, you would actually make a profit on that sell. Now, if some of you people who are a little more advanced with stocks, you're like, yeah, well, there's other ways too, because you can actually make profit when the stock goes down. So yes, there are more technical things where you can actually bet on the market going down. And if it does go down, you make a profit that way. But for all intents and purposes, let's just focus on the more traditional way, the more, standard way of investing in stocks, which is, basically, if I buy at a certain price and the stock price goes up, if I happen to sell at that point, I do make a profit. Now, keep in mind, as a little side note, you don't actually lose or make money until you actually sell. And this is really, really important from an emotional standpoint, because you may happen to invest in a stock, and the minute you invest, all of a sudden the stock is going down and you start freaking out. Oh my gosh, I'm losing all this money. You don't actually lose until you sell. So if you truly believe this company is a good company and that long term it's going to be around for a while and it's going to continue to grow, if it happens to go down for a little bit, that's okay. If anything, look at it like a discount. Think about it like clothes or shoes. Let's say you have a certain pair of jeans or some shoes that you've been looking at. Let's say they normally sell for $100, and you happen to go to the store one day and you see that it's on sale for $80. Well, that's usually when you get the most excited. You're like, oh, heck yeah, it's a good deal. Well, think about that way when the stock goes down. It's the same thing. If you're investing in Apple and Apple happens to go down 5 or 10%, and you believe that Apple's a really great company that's going to continue to grow over the years, well, if it goes down, you should look at it as a discount. So remember, you only actually profit or lose money when you hit the sell button. But that brings me to the next point. So like I said, the very first one is you can make profit on buying at a price and going up in value than selling. The other way in which you can make money investing in stocks is through what's called dividends. Now, I actually have some videos on dividend investing and how that works. But in essence, certain stocks will actually pay you what's called a dividend for being a shareholder or owning shares in the company. And that's going to depend, the amount depends on the company. It can range from as little as 0% all the way up to 10+% per year in interest. But essentially companies, depending on the company, every quarter they will send you a dividend check. So, let's say you invest $100 on a stock that pays a 10% dividend. That means that every year they will send you basically $10 over the course of a quarter on your actual earnings. So what does that mean? So that means if you own $1,000, 10% of that is, $100. If you own 10,000, that's 1,000. So, but they will pay that every, over the course of a year through quarterly payments. So that's what's known as dividend investing. So the very last thing is, how much should you invest? So now that we have a really good understanding, we're starting to understand what we should be looking for in things. The next question becomes, how much money should you invest in the stocks? Well, the general rule of thumb is this. Number one is you should never invest more than you're willing to lose. So listen, there is no such thing as a risk-free investment. Anytime you make an investment in a stock, you have some risk that the market may tank or that company may, fold. But there are companies that are less risky than others. And so if you're going to invest money, pick an amount that you're willing to lose. So the other thing I would advise is make sure you have an emergency fund set up. So you don't want to be investing money that you really could use in case of an emergency. So make sure you have an emergency fund built up. But after you have that amount, pick a certain percentage. My start would be probably like 10% or 20% of your additional income that you're saving. So take 10 or 20% of your income and begin investing in the stock market. And whether you're doing that every 2 weeks, whether you're doing it every month or every year or semi-annually, whatever, but pick an amount and steadily invest over time. And this is what's called dollar cost averaging. And that's when you pick a certain amount of money and you invest at a certain frequency. It could be every day, it could be every week, every month, every quarter, half, every semi-annually or every year, whatever, but invest frequently and invest a small percentage. So, most stocks don't require certain amounts depending on the app that you use, the brokerage you use. Some may have a minimum amount. There are certain funds out there where you have to have a minimum of $500 or $1,000 to start. But a lot of stocks you can invest with very, very little, even just $100. Especially nowadays with what's called fractional share investing, meaning that you don't actually have to buy a full share. There are some companies, there are some apps and things that require you to, when you invest, that you have to buy a full share. So if you're trying to invest in a stock that costs a couple $1,000, like, you will need a couple $1,000 to invest. But if you're investing with something called fractional shares, if you only have $100, you can still put $100 towards owning a portion of one share. So my suggestion is start with what you're most comfortable with losing. Pick a certain percentage that you're willing to invest every week or every 2 weeks or every month. It could be 10%, 20% of your earnings that you make with your work, and then just steadily invest over time. Anyways, that is it for today. That's a ton of information, so make sure that you watch this again. Hopefully you're taking notes. If this provided value for you, please be sure to smash that like button for me. Hit the subscribe button channel if this gave you some great value, some great insight. I want to hear your comments below, but make sure you check out some of my other videos for other great information. Let's get out there and let's build that dream.